Cool. So today we're gonna kick it off and kind of go through our actual deck and offering, right, for the Pave Nation one here as well. And I know we've gone through a lot in terms of the business model, right? Why the roll-up space, things around SBA loans, right? Kind of going into this from a corporate world too. So today we're actually gonna cover what it is that we offer internally in terms of our offering to investors and kind of why we structure things a certain way here too. So we're gonna dive into it. You have questions, you have comments, feel free to throw them into the Q&A section as well here too. We'll get to all of them at the end. But yeah, definitely make comments, dive in here as well too, and we'll do our best to answer all those questions. To our actual offering for Nationwide and the Pave, and this again is a paving and asphalt maintenance platform, right? Roll up that we are focused on going out and acquiring companies in and around the paving space. So right now, this open raise is $30 million. In terms of the structure, we'll get here in a bit. We got $14 million already in committed, and we're having 8% current pay tied to this as well too. So quick disclaimer here, again, read this on your own time in terms of the kind of typical disclaimer when looking at offerings as well. This is a 506C. And on our end, right, our big thesis here, so we've covered in the past, is that our intention is to go out and acquire paving companies, right? We see a huge opportunity right now to go out and acquire companies in the 2.5 to 4x EBITDA range in a really fragmented market. And Chris and I, before we dove into this, like, Chris, how many industries did you look at prior to landing on paving?
It was like, close to 50.
Yeah, and paving just really gave us an edge for a few reasons, right? Like we'll dive into all of them here as well, but like we dove into all things around service companies, around tech, around every industry you can go think of to land on paving. And right now, again, acquiring companies in that 2.5 to 4x range. We're looking at some companies that have recurring revenue, right? They have big name clients. Also looking at companies too that have public sector work here as well. And in our end, right, we bring a really big operational edge. I think a differentiator you'll see with us versus other groups is that, yes, we have more of the private equity like background in terms of M&A, work with investors as well, but we really have the family run business aspect to us too, and decades of paving experience internally, which what you'll see is that most groups who are trying to do something similar, whether this industry or different industries, that they may have one of those pieces, but likely not both. So we feel like this is a huge advantage for us and how we built the team together too, which we'll cover here soon. And the reason why we like paving so much as well as here too is that the multiple expansion is massive. So what we're seeing is you can go acquire smaller companies at a lower multiple. You get a level of scale, you get a level of a legitimate platform, and you integrate those companies as well too. What you're seeing, we have some examples here as well too later, is that multiples jump substantially from a $5 million EBITDA company to a 50, 100 plus million dollar EBITDA company as well too. And again, like, why do we like paving? So, there's a massive market when looking at the space as well. Like, for example, we're working through a list right now just in Texas alone. We love Texas, is that there are 700 plus companies just in Texas doing over $10 million a year of revenue. So what you're seeing is that it's a very fragmented space in terms of who actually dominates it. So what we see opportunity to go do is acquire these smaller companies, integrate them, right, and really use the tailwinds of the economy as well. You're seeing a huge push around the federal spend. You're seeing a huge push around the quality of roads. Kind of a sidebar here for a second too, but if you go think of how good the quality of roads and lines have to go be for all these autonomous, vehicles to actually function on them, the bar is not just what it used to be, it is dramatically higher as well too. You're also seeing that these large companies need to have their parking lots perfectly dialed in. Otherwise, they are at massive risk for someone falling, an injury, and then the big insurance boys coming after you too for claims as well. And a really important piece here too is that the owners of the paving space are looking to go exit. And they don't really have a traditional retirement plan to go pass business down. You're going to think about who that owner is. Their typical profile is probably between 58 and 72 years old. They've been in the space for 30, 40 years. And for them, their kids grew up now very wealthy because dad had a great business. And in turn, they don't want to be in the paving space anymore. They want to go be a doctor, a lawyer, get a white collar job, which creates an opportunity for us to go find a win-win scenario, help that seller transition to kind of the next phase of their career or retirement here as well too. And this, I think, what really separates us as a team So Jeff Livingston's in the paving space since 1995, and for him, like he really comes off as he is the guy who started on a paper himself, but has really made it in terms of operations, in terms of experience, and he has a really unique way of both motivating the crew, working with sellers in terms of a one to a peer to peer experience, but really just helping be that bridge for us on the operational side of it, and making sure that Chris and I can execute on the whole financial integration piece of the company as well. His son Jeffrey has been in the space. I believe Jeffrey jumped into high school to go join his dad in the business, right, Chris?
Sixth grade. So he was working full time, sixth, seventh grade.
Yeah, which is just like it's awesome seeing that the dynamic like between the two of them too, like in terms of the trust, in terms of the experience and depth, right? Like that is all he knows, and it's for us. No one can do a job better in terms of difficult paving jobs, and it's so crucial because if you look at it, right, we do some multi-million dollar jobs, right, for the government, and those jobs aren't done perfectly. We have to go redo them. So having someone like Jeffrey in house to be able to go make sure jobs are done the right way, teach the crew the right way as well too, it creates a massive differentiator for us to have that expertise in house versus having to go rely solely on sellers we're working with. Myself, I head up the capital markets in terms of all things with investors, banks, etc. Alex, who's actually on a previous episode here as well too, if you want to go back and watch it, she came from Deloitte. Her focus is integrating companies, and she is great operationally. Brings the MBA experience here as well too. And Chris, I'll kind of let you share your background too as a CFO.
Yeah, my background is as Sam mentioned. I handle all things finance, so everything from due diligence and underwriting companies that we are going to acquire, all the way to making sure that our financial insights and data from the company are good, and that we are compliant with all the different financial covenants that we have.
And again, right, we look at this as kind of two sides of the coin, right? We try and operate as if we are an institution on the operations side, on the capital markets side, on the financial side, in terms of how we want to go make this experience both investors, but also for our partners, and also looking forward, potentially the future acquirer of this business too. But really looking at it from like the operator experience of having the true field experience to go get our hands dirty, go make sure we really go create, value in these companies and go have alignment and buy-in for both the employees, the vendors, the partners, everyone involved here as well too. So for us, like we really harp on the field experience that we have. And that's really tough to go hire for. Having someone who is that ingrained and that deep in the experience that, we now brought in house as we saw it was a crucial part for us to go from where we are today to substantially grow going forward. And Chris, kind of want to cover here too of like what makes the platform itself just defensible and really why this industry itself too.
Yeah, so when we decided to go in and invest in the asphalt paving industry, before we even identified asphalt paving as an industry, we took a step back and said, what are the attributes of a company that makes it a great company, that makes it a wonderful company? And so we looked through and we ran through a bunch of different industries, and we created, investment commandments. So essentially those, eight or 10 things that we felt made, a company, a great company and somewhere that we wanted to play. And so, a couple of those things were barrier to entry. So the barrier to entry for asphalt paving is really high. In order to get a crew that has all the equipment, you're looking at millions of dollars in equipment, and then you're looking at a lot of different compliance and regulations in order to be able to get approved to go out and do work. We saw that there was a lot of money coming in from the government, over $350 billion via the Bipartisan Act, which was also very compelling. And then, another really kind of not well-known thing about the asphalt paving business is that you have these really great uh, Fortune 100, Fortune 500, Fortune 1000 companies that can really anchor, the value of the customer. And, we do work on the nationwide side for, CVS, Taco Bell, Walgreens, all these big major big box retailers, and it creates um, a really solid customer base that has a lot of recurring revenue associated with it.
Cool. And again, right now the portfolio itself is made up of three companies, right? Looking at Nationwide Corporate, again, they're focused primarily on the Fortune 100 to 500 to 1,000 company base. We have their kind of portfolio companies here as well. Cornerstone right now is focused primarily on the DOT work in the state of Texas, and then in Dino Contractors is really focused on being a subcontractor, being a sales org for subcontractors in the space as well too. And our next acquisition, right? We have under contract here. We expect to have the quality of earnings here back soon. Kind of just walking through. I think a really big piece of this acquisition is showing that 1 and 1 on our end can now equal 4 or 5 or 6 or 7, and it happens for a few reasons, right? Is that our company in Texas today does a lot of concrete work, right? We do probably $6 or $7 million of concrete work per year. And right now, that work gets passed to a subcontractor at zero margin. So we have the ability to go do is acquire a company that does work that we need to go bring in house. So we can go control more of that process being vertically integrated. One, in terms of quality of work, and two, in terms of keeping more of those margins in house as well. So we're not getting to a place where we can go acquire a company, bring work in house from a company we already own, or vice versa, and really creating that symmetry between these businesses as well too. This here on the left is just kind of more of a sample deal structure, right? $13 million in total, $9 million in closing, $4 million in seller notes, right? And kind of structuring both between debt and equity. I think a really important thing here too is that, the one of the owners of the company, we would have looked to go hire either way in terms of their skill set and competency here too. So on our, we're always looking at, talent being involved as a huge part of our process when looking at this too. And as Chris mentioned, right, there's some really big brands that we work on too, right? For example, we just did a job in CVS in Buffalo, New York, and I'd say it's a really good example of like how important it is to have a flexible team and structure. So Nationwide itself is located in Ocala, Florida. We were able to go do a $17,000 job in Buffalo, New York, which if you don't know is borderline Canada. It's way up there. And in turn, we sent one guy for 24 hours. He was able to do that job, rent equipment from a local Home Depot, and go get it done. We do own the bulk of our own equipment. The reason that was just more so a logistical piece of it as well, right? That allowed us to be really efficient, and that had a massive margin tied to it as well too. So for us, we can really service different businesses wherever they are in location, and speed and ability to execute quickly is a huge part of how we're able to go not only win clients like this, but also maintain them for a long period of time too. And Chris, if you want to kind of cover the growth of Cornerstone as well too, and also touch on, I think, the working capital piece of it as well. I think people look at this sometimes too of saying, if you go out and acquire a business that, you can go do as lean as possible, right? I think here is a really good example of how important working capital is to make sure you can go really grow a business the right way.
Yeah, in the asphalt paving industry, it absolutely takes money to grow the company. When you look at Cornerstone, one of the unique things about Cornerstone is that they are able to backlog work with the government. So they can have a 25, 30, $35 million backlog of work. So what it allows you to do is it really allows you to turn up or down the dial. And really what these guys, the previous owners, have been doing, over the last couple years was that they had built the foundation that would allow for growth. And so one of the compelling aspects when we bought the company was we felt the foundation was there for us to go in and turn up that dial. And as a result, we've seen really great revenue growth because we can control how fast we move through the work because it's a function of putting in another crew. Now, to get another crew operational, it's about $1 million, maybe $1.5 million. And so you have to carry that cost and you have to invest that. And so I think to your point, Sam, the idea that you're going to be able to go in and grow a company and, be able to run it super lean and highly lever it and then take a huge salary and all this stuff. It's just, those two things aren't very compatible in my experience. So, working capital is really the way to grow in this industry. And we feel like we have a great plan on that with this company here in Texas. We've executed on that plan and we've seen the results.
Yeah, and again, when you look at the kind of flywheel around acquisitions, it really is a simple process, right? Simple, not necessarily easy, right? You're looking at sourcing companies that have retiring owners that are kind of too big for that individual buyer, right? Usually being priced out of SBA loans and also priced out of the competency in terms of the moat around this industry itself as well, but also too small for traditional private equity. What we've seen is that bigger private equity shops typically shy away from, say, sub $10 million EBITDA companies. And the reason is that they likely don't have the same experience we have internally as it relates to actual paving operations. So in turn, that smaller company or smaller to them may not be the most comfortable thing for them to go do, right? So feel there's limited buyers in this space, right? In turn, we can go create really great win-win scenarios, both us and the sellers. You acquire them, integrate them in terms of SOPs, optimize for both revenue and margin expansion. And you're starting to see margin expansion too by controlling more parts of that equation. So in a full job, there may be 10 pieces of work. The closer we can get to doing all 10 pieces of work in that scenario, then typically the higher the margin that we have as well here too. And what you're seeing is that the ability to go compound, right? From looking at, each company starts feeding each other as well. And then the exit itself too is that you are getting a boost in terms of your multiple by doing things like the better you integrate and the bigger you are, typically give you an expansion when looking at the multiple itself too. And here are some quick projections in terms of kind of back the napkin as to where we think we'll land for this year, right across the board, and kind of showing the numbers as it relates to multiples when looking at this as well here too. This, I think, is a really important slide here when looking at the different companies that have exited this space so far. I think what you're seeing here too is that if you get some scale, there is a meaningful amount of value by being larger. So really just kind of highlighting here is that there is a meaningful appetite for the space right now in terms of acquisitions. And what we're seeing is multiples are far higher than what multiples are that we can go trade it ourselves. Additionally, if you look at the base in this space, Construction Partners Inc. under the ticker ROAD, they trade anywhere from 19 to 22x their EBITDA when looking at kind of their public stock price. Again, there are certain things that they have that we don't that give them some, a bigger upside, but more so showing that this space has a lot of room to go run overall as well.
I think the important thing to add here on Lone Star Paving, the multiple was 7.5, but they also took like 35% of the deal in CPI stock. And so I think that definitely played into the overall compensation's not really reflected in that multiple.
Yeah. So that multiple definitely is lower than it would be. But even if you kind of play it out, like if we're acquiring at 3 or 4x and you're selling at 7.5, there's still plenty of room there as well. And that we view as a anomaly too, as the stock price since acquisition has gone up substantially, right? We're kind of looking at that as well too. So good call out. And again, the actual offering itself. So we took the stance that this is a business that we want to be able to go own ourselves for a very, very long time. It's very operationally intensive. We have built the foundation for the last few years, right? Jeff and Jeffrey for the last, 8 years building Nationwide as well here too. And in our end, we're looking at actually raising all of the money that we're working with investors on as preferred equity. And we'll cover here what that means here shortly too. But the highlight is that we view this as a much lower risk position than common equity, but we view this as the ability to get common equity like returns. So we view it on our end as a path of getting lower risk, but also still getting the great return profile as well here too. How we've structured is that in our higher class of share, and we have 2 different classes of shares based in checks, which we'll cover here as well. There's 8% current pay, right? Target for years 1 and years 2. Also the option to actually get liquidity at year 2. So this is really big. In a lot of private placement type deals, the big downside you give up is illiquidity. On ARM, we look to go build that into a predictable model where you can go programmatically buy out investors at years 2 or years 5. What you're seeing here as well is that after year 2, cash flow jumps to 12% per year for years 3 through 5 with a structured buyout of 3.24x. We'll kind of dive into what that means as well. So kind of seeing it here in actual numbers, right? Based on share classes, right? So there's a breakpoint for larger checks. The return profile is substantially larger the bigger you come in. And there's a structured liquidity path for years 2 and years 5. The really nice thing here too is that you have to elect in 18 months, not today. So you have that flexibility for the next 18 months to decide, what you like, where you are in your life, what's best for you to make that election as well here too. And kind of showing some more illustrations as to what that looks like, IRR projections, total returns, etc. And again, something we're doing here too is that as we get bigger, the credit profile of the company gets better and better, both between lenders we can work with, capital we can bring on. So what we're doing is that every tranche of capital, call it $20 million, $30 million, we are stepping down the return profile itself too. So our returns today in structure will be greater than our returns tomorrow. So there's usually in a fund or an offering, the last money in is the best money. Actually, in our structure here today, is the first money in is actually better money. And I think this is a really important thing here too, is that when you look at how the structure is and kind of where the capital stack is as well here too, is that first it's senior debt, right? That is a bank facility that is paid first, of course. Then from there, the preferred equity sits in right behind it. And all of the enterprise value of the company and the kind of owner capital sits behind that as well here too. So it's very aligned in structure, which creates a more predictable exit for investors, but also us as owners, the common equity, putting our compensation way behind this. So that's really important when kind of looking at the structure here too. Say, for example, we ever behind on a preferred return or a buyout, right? We cannot go take out distributions. Chris, you kind of want to walk through like what the liquidation class actually means?
Yeah, so the liquidation class is a mechanism designed if, like, for example, there wasn't enough cash to be able to buy out the investors or to be able to refinance out the investors. What would happen is the investors would drop into a liquidation class where they would capture 100% of the excess cash flow. And they would get 100% of that cash flow until they were completely paid back.
Yeah, so that just really makes sure that the interests are extremely aligned. Like we cannot take money out of the company itself if we are behind on those payments and structures too. So we feel like this provides a really good structure, really aligned structure, and really helps compensate investors for the position that they're in. And I think this important thing here too is like you see the numbers, right? They're really strong returns in our opinion. And you look at the different ways that we can go buy investors out, right, to get them their capital back. So number one is that we can go do a refinance across the portfolio to return capital. And a common path this would be is that we acquire a business and they're doing, say, $5 million EBITDA, and we take out 1 to 1.5x leverage from the bank day one. Means we have, 5.5 to $7.5 million of debt day one. What we've seen is that there are lenders who are comfortable going between 3 and 4x the EBITDA of the business once integrated, meaning that we can go acquire a company, 1.5x leverage. We can go integrate that company into our portfolio. We own it already. We've been operating it and saying, hey, you know what? We want to go pay back our investors in the structure, take on more leverage from you all. And actually, our cost of capital would likely go down from the investors to the bank capital. As what we've seen most, loans we're looking at on the institutional side are between SOFR with plus call 300 basis points, which gets you to about 7% or so. So it actually is less than our cost of investor capital here as well too. So that's our first pathway. Number two is actually operating cash flow. So we'd have operating cash flow likely in excess of paying down our debt payments and also paying the preferred return to investors here as well. So that can either be used to do two things. One is pay back investors, or two, use to acquire or grow net new EBITDA, which then makes path one an easier route as well too, as you have more EBITDA to go refinance against. Also, as you saw in previous slides, that our cost of capital goes down each round as well. So in turn, if we have to go replace capital with new capital, the cost ourselves is actually significantly lower. And I say lastly, we can potentially do a strategic exit or recapitalization, resell off a part of the portfolio itself too, to allow ourselves to go bring in cash to go pay investors down as well. But again, none of these really tied to needing an exit, more so just allows us different optionality to go have kind of more consistent programmatic investor buyouts as well. I think this slide here is great too when looking at the leverage versus our EBITDA. So a metric we look at internally a ton is what is our EBITDA projection based on how much capital we can go bring in, and then at a leverage multiple of say 3.5. How much coverage do we have to go return all of our debt, all of our seller carry, and all of our investor capital at the programmatic buyout here too. So what you're seeing is that we have ample buffer room in the downside, mid case, and high case scenarios across the portfolio itself to allow us to go get investor capital out programmatically. And then kind of looking at the tax piece of it, right? Obviously consult with your CPA, but in terms of distributions, right? This is more so a partnership distribution. But the long-term piece of this is a capital gain, right? Long-term capital gain here too. So again, right, really tax efficient on the biggest piece of the investment as well. And Chris, you kind of want to talk through the use of proceeds as well here too, in terms of where the capital actually goes once it's brought in.
Yeah, so the majority of the capital goes to acquiring net new EBITDA. Um, with anything, when you're buying a company, there's going to be due diligence costs and different fees and lawyer costs that will need to be funded out of the raise. But the vast majority is so that we can actually acquire the company. And then we hold back a little bit so that we can put some cash on the balance sheet of the company that we acquire. And that just allows us to be able to go and make the investments and make sure that we're really well capitalized going into the future. And as we mentioned in the previous slide, is our plan is to go in and grow these companies. And so that extra little bit of capital that we're putting on the balance sheet is what is going to help us fund that growth. I think it's a when you look at growing the company and you look at wanting to grow the company aggressively, you need cash on the balance sheet to do that. And so we've just kind of engineered that into how we're deploying the capital.
Cool. And on our end too, we are working through full audits. We use outside counsel as well. We use a investor portal in terms of investor experience here as well too, and we're working on different banking relationships here that we feel help us a lot too in terms of bringing on significant leverage. We actually had a term sheet from an institution that wanted to go back us substantially, right? I think the more important piece that here is that when we're looking at it is that they've gone through their entire due diligence on us, right? And we passed that test. So we're kind of looking at the depth of our data room, documents, all that's there upon request here too, is that we've gone through the ringer when looking at the what institutions want when they potentially partner with the business, which I think in the future will help us potentially exit the company as well too in terms of seeing what it is they want to go acquire. And Chris, do you want to kind of touch on a few of the risk mitigation factors here too, before we wrap up?
Absolutely. So, like with any investment in any business, there's going to be a risk, and you have to be prepared to handle that risk. In terms of asphalt paving in our business, the risks that we really see, and I'll just touch on a couple of them here, but is cash flow and liquidity. If it's raining outside or if there is any adverse weather, we're not able to work. And so that can create some lumpiness in the cash flow where, if you have a couple bad weeks of rain, your cash flow will be constrained, but then as you go throughout the year, it tends to level out. When you're acquiring these companies, no matter what level of due diligence you do on these companies, it is always there's always going to be things about those companies that you do not know or you cannot find out until you're actually the owner of the company. And so as we're integrating the acquisition, ruthless execution on that portion is required and necessary in order to be able to get the company and their culture and all of those things integrated into the platform. And there's just a lot that can go wrong in that process. And that's why we hired, Alex Lobig with her background, is because she has seen this and she has done this. And so that's a big risk right there. The other thing is labor constraints. There is more work than there are people to do the work. And so finding great crews, finding great people, and being able to recruit and maintain talent is also a risk because without our people, we don't have anybody to do the work, and we're nothing without our people. So that's always a challenge in this industry is recruiting and retaining top talent.
Cool. Yeah, all really good points too. And again, I'd say the case for acting now is well before we can wrap up here too, is that the tranches of capital on our end is that the returns today are higher than returns tomorrow in structure itself. I think we already have a really great base itself too of companies to go scale. We have the right team in place as well too. And we think we have a limited buying opportunity right now in the paving space next 12, 18, 24 months. We feel like we can acquire companies at a really competitive valuation before pricing and the market really starts getting too hot. So again, thanks everyone for kind of watching through this as well here. But we'll open it up for questions. So feel free to drop in the chat as well too. We'll hear one in a second here, and then we can hop if we don't have too much. So how big is the Pave currently? In terms of Steven, if you want to share kind of what you mean by that in terms of revenue, in terms of EBITDA, in terms of team, I feel like we can kind of just cover all those too. Kind of looking at EBITDA this year, including nationwide, we think will be in the high teens overall in terms of EBITDA. In terms of revenue, Chris, top line, what does that look like across the board?
It really depends on the performance of, of the growth we're experiencing in Texas. I think, kind of a low case would be 60, and then I think a best case would be just under 100.
And that's not including any kind of new M&A as well. Just companies we currently own and operate today, which we should grow past that. I'm kind of looking at new companies we acquire. We'll everyone in a few seconds here, and then okay, cool. Well, everyone, thanks for hopping on. Stay tuned. We'll get the recording out here shortly. Thanks again. We'll see you soon.